When most of us read the CRA's Information Circular IC 7810R5 on record keeping, it seems like they think the primary function of Canada's small businesses is to document their business transactions and store them so that they can be accessed easily by CRA auditors. And if you followed the record-keeping checklist that some bookkeepers and accountants put on their websites, you wouldn't have much time for anything else. But isn't your main job just making great products and services and selling them to customers? At The Hatchery, we train our technicians to understand the rules, so you don't have to. Admittedly, there are lots of things to juggle. The trick is to know what's important and what isn't, and to know who's got your back. When it comes to incorporated businesses, companies have responsibilities to maintain statutory corporate records. That's why small Canadian corporations should appoint a law firm as the registered records office. That way your corporation won't be struck for failing to file annual reports, and you won't give disgruntled shareholders an excuse to make life difficult for stupid, clerical errors. According to CRA's record-keeping rules, you're required to keep records for 6 years from the end of the last tax year they relate to. That sounds kind of like, till death do us part. However, the CRA can't go fishing for information from statute-barred years to reassess beyond the normal reassessment period, which is usually 3 years after the date of the assessment notice for the year in question. That's right, the normal rule is just 3 years. There are only 2 exceptions. First, when a taxpayer is guilty of fraud or gross negligence, which isn't easy to prove, especially when you make a point of never lying on tax returns. Lying is never a good idea. And second, establishing the cost of capital properties when you want to sell them. At The Hatchery, we train our technicians to know what matters. We think it's important for our clients to relax when they get the chance.